Hello, folks. Welcome to the State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone as always. Today is Monday, July 14th, 2025. And we're going to be looking at the big indexes and sectors today. That's what we do in State of the Market. Let me first share a few important disclosures with you guys. Now, remember that we do State of the Market on Mondays. You look at the big indexes and sectors. And then on Thursdays, we do market trends. We look at more nuanced things involving economics and individual stocks, individual sectors, and things like that. Great. I'm going to show you standardized returns of some key ETFs. Now, also remember that TradeStation is preparing to launch TitanX, the next generation of our trading platform. It isn't just a new model of our award-winning software, but a fresh trading paradigm that puts you in the cockpit like never before. TitanX will be available to customers as a beta soon. If you're new to TradeStation, you can join the waitlist at tradestation.com/Titan-X or see the link in the description of this video. I also shared it in the chat. Great to be with everyone. All right, so some key ETFs. Now let's also go over here and show you where we have some information about some of the things we're going to be talking about. If you go to tradestation.com, the main tradestation.com page, and you scroll down, you're going to see we have blog posts here. And this is the one that we are going to be kind of covering. Some of the items that we're talking about in terms of the big indexes are based on this. But also want to point out that this article here that we did, this is our last market trends. Earnings season is getting underway. So in this last webinar we did on Thursday, we actually had some guidance of how to use TradeStation's platform to kind of navigate earnings season. Some of you want to look at, check that out using the platform earnings. Just some quick little things. I wanted to remind you guys, in case you missed one on Thursday, that we did actually cover that. And it could be useful as earnings season kind of ramps up. So this thing here with the sleeping dog, kind of an interesting point. So there's a chart down here, but I already honed in on the chart, and here we go. This is the average true range. I want to point this out. This is the average true range that is really narrowed down. So last week was the narrowest week in terms of just pure points from high to low that we'd seen since December. So as the market has moved higher, we're just seeing smaller and smaller movements. So I think it's an important thing to realize. This sort of thing can happen before reversal, but it doesn't have to. I mean, just because it's happening doesn't necessarily mean a reversal is coming. But it does just kind of show that we've had this very powerful and dramatic rally, and now we're at a spot where the overall momentum is just kind of slow and just kind of sitting here. Now, you could have said similar things, not quite as much, but around here where we went to a period of a month or two of sideways movement. So I want to just point out, to me, it's pretty interesting to see that we have this falling average true range. And we also have a very tight week last week. We're in a new half. So those things I think are kind of important just to realize that we're in a spot here where movement is really slowing down this kind of period of the summer, and things like this can happen. So I want to point out here, let's jump over and look at some of the charts, because to me, look at the chart of the weekly of the S&P. It's the main thing we always focus on to begin with. So remember, tomorrow morning we have CPI. Now, this is important because, the CPI could have a big influence on interest rates, obviously. If we're in a spot here where people really believe inflation is coming down, and it's a spot when the Fed might feel more comfortable cutting rates or something like that, that could be something that have a positive impact. At the same time, if it starts to show the impact of tariffs, that could be a problem. So it's interesting. If you actually look at the article we did here, it could be a problem for the bears, I should say. We outlined these, and there was another thing that happened after. So basically, there was this thing with the BRICS countries, with Japan and South Korea, Brazil. There's this whole thing about more tariff sort of drama today involving the European Union, really potentially high tariffs on pharmaceuticals. So if you want to, and on top of that, we also have this whole kind of conflict between the Trump and Jerome Powell and things like that. So I mean, if you want to, you can see a lot of bad news forming here. There are things that could be bad that potentially could drive the market lower, but at the same time, we have no confirmation of it yet. So I think it's important just to realize that these things can kind of sit. When you look at the way the market behaves, these things can build for a while, and then suddenly everyone focuses on them. And so just because we're seeing the bad news doesn't mean that it's going to impact the market right away. However, if it does start to impact the market, then go back and say, wow, all those things are kind of building. And so I think that's kind of something to think about. Right now, we have CPI in the morning, then we have earnings season cranking up, we have retail sales on Thursday. So those things right now put us in a spot we're kind of watching to wait and see. And you could plausibly put together a situation here where the S&P essentially is going to reverse to the downside because of all this kind of bad news and things like that. You could make that potential narrative, but at the same time you can make another narrative, which is that CPI might cool, retail sales might be kind of lackluster, and we might be looking at a Goldilocks sort of environment of rates low and lots of small high beta stocks moving the way we have been seeing to a different extent. We've been seeing things like M&A. We've been seeing like small tech IPOs taking off. There has been an actual thing here of small high beta stocks moving in different ways. We had a breakout in silver, which we talked about last week. So a lot of these things are happening here, which could go into an environment of a prolonged period of relatively small movement drifting over the summer with individual things just ripping higher. So I think it's important to realize that this could go either way. And as traders, you can see potential either way, and you need confirmation. And at this point, there's no visible confirmation of the bearish case yet, but there are some warning signs about some things that could potentially be problematic, which we are going to get to. So I would just say I think it's important to realize CPI on Tuesday and retail sales on Thursday. These are important to kind of remember are out there now. Last week, I just briefly mentioned, we don't normally talk about this, but we did on Thursday, we talked about silver, and it was basically down here on that Thursday, and we were talking about how it was holding these levels. And now we have something of a confirmed breakout to 14, 15-year higher in silver. This is something I think that kind of like crypto, it has that kind of potential. People might view it as something that has some potential to extend to the upside. So I want to just kind of point this out, is that this could be something here that could become a good kind of trend that could, kind of give itself some opportunities over time to potentially extend. So I think that, something like this thing happening now in silver could be something to kind of pay attention to, and people can do stuff with options and things like that as well. We talked about it. I wanted to kind of remind people that it is something that's coming up. Remember, earnings season also, check out the last one, the last webinar we did on Thursday. Okay. So now I think as we look overall, I just want to mention this really briefly here, is that in some ways you look at the market overall, the overall S&P, you can say that a lot of good news is priced in, and there's this tariff stuff that could be coming along. So like I said, it's one of these things when you have to just kind of wait to have an actual confirmation that a narrative is being priced on. It kind of reminds me of something like Palantir. People are saying Palantir forever was a great, amazing growth stock and all that stuff. And this, if you look back, 2 years ago, Palantir was basically just languishing with other growth stocks. And there was all this people talking about, all these positive things on it. And it took a long time, but then when it broke out, it started to happen. So you had the confirmation. I think it's just important to realize here that you can have a narrative building for a while, and it might be true, but the market, you need to wait for the market to actually act upon it. And so I want to just emphasize that we could have a situation where the market drifts higher and all these things, and then suddenly we have something negative in August, September. And it's important just to realize that it can flip one way or the other. And I just want to emphasize that confirmation is important, and we have to be kind of open to the now flow of opportunities, as Mark Douglas would kind of put it. And the now flow of opportunities points toward a quiet drift with individual names popping and moving and things like that. All right. So, the other thing I'll mention is that there is a belief in the market that tariffs will essentially go away, or they won't be as bad as feared. Now, you might argue that the impact of tariffs is not going to be all that bad. But I think that also we have to realize is that the market doesn't believe that. It's not mainstream economics that believe that tariffs are going to be benign. So the thing is that if we have this kind of confirmation that tariffs are going to remain at higher levels or get worse, like, for example, the talk of this thing they might do with Russia, which could have knock-on effects on other countries like China. If things like that do start to take hold, the market may not take a glass half full kind of look and say, well, maybe we're going to weather tariffs or something like that. I think it's important to realize now that the underlying assumption is that the tariffs will essentially end up not being as bad as feared. All right, so Let's look at the S&P 500 here. The S&P 500 weekly chart. We always look at this, and from my perspective, there's no real clear opportunities. It's interesting to kind of see. We did break out on a kind of low volume period around the 4th of July. Our high was actually, we made a high right around the time of the quiet trading day before the 4th of July. So from my view here, there's really nothing on the S&P 500 in terms of any clear opportunities. We did mention this very tight range, which is a different chart here that comes from our article, very tight range. And so, from me here, the most important thing is that we're basically just staying above this level. And from my view, when you look at a market like this on the weekly and the S&P, a market like this will often see the S&P do not very much, but individual high beta stocks move. And that's the kind of opportunity people might be looking for. Individual high beta stocks with breakout potential. Now, I want to look quickly at the daily chart of the S&P, because what's interesting to me here is that the RSI went to overbought. Let me just zoom this open on TradingView, you can see. But what's interesting here at the RSI going all the way up to like 75 is, once RSI goes overbought, it can stay overbought for a while. And so, or not necessarily stay overbought, but the market can remain, relatively positive for a while. So this environment does look a little bit like we saw, last July, where we kind of rallied up. You guys can see right on the mid-July, we rallied up, RSI went to overbought, and we kind of, then had more of a sell-off. Now, the difference about that is the market had been running a longer time at that moment. And at this point, I think the more important thing is just the fact that RSI hitting this level is not actually a sign of anything being bearish, anytime soon. So I wanted to just mention that we could be at a spot here where this turns into a period of long sideways movement that gradually breaks down into August. And that is often kind of what you see. July is historically one of the most positive months. I think every July for the last 10 years has been positive. All right. So the RSI, I did want to mention that as being a potentially kind of bullish signal. If you look at the Qs, it's very similar. It's essentially just holding a breakout. In my view here, we're kind of forming this tight kind of price action. But this is an area here, I think, when you look out, it has kind of a more potential upward bias as we get into those XLK, XLC. We're going to start to see that. Those are such important sectors for the Qs here. So the Qs here, holding this breakout is important, but it's interesting to see how we had that high back there in late June. Then we held it at the beginning of July, and we're holding it since. It's very tight. This one may potentially have more potential for some real extension. Now, the Dow is a whole different kind of kettle of fish. The Dow has not broken out to new highs, and it's kind of stuck below the, way back where it was in November. So from my view here, people who want to be looking for continued upside in the Dow really need to look for potentially for a breakout above. We need an all-time high on the weekly closes. It's really interesting to look at the Qs. Once we have that record closing high, we get extension. This is a pattern that we look for in this webinar a lot. We look at the weekly chart, we look for a record weekly close, and then we look for potential extension. And what we did not get in the Dow was a record weekly close. It did not close above its November high, and it still has not. So from my view here, people might want to be waiting for a clear close above that level before there's much of anything. And I think that's just, one of these patterns. And the Dow is just a strange, I'm not even sure really what to make of it now, the mix of companies in it. But I wanted to just point that out, that it has not given us this confirmation. Now, the Russell is kind of similar. Obviously, it's nowhere near high, but this one's a little bit different because in some ways, we're starting to see more M&A. There was another M&A. I don't have it in front of me. There's a little bit more M&A today. There's more of a sense now of mergers of happening, of things like big pharma companies buying small pharma, small biotechs and things like that. And all that is potentially positive here for the small caps and for the Russell. So from my perspective here, this is actually one that people might look for if the market remains benign, this kind of drifting, if the S&P kind of sits and drifts and just remains above these highs, the S&P could meander slightly higher, and something like the Russell could potentially outperform, in that environment. Now, I think the other important thing to remember at the Russell is that with CPI tomorrow, a cool CPI reading could turn into something that pushes down yields, and that in turn, historically, when you look at the relationships, could be positive for the Russell. So from my view here, this is one that people might actually want to look at, a potential for this to move its way back up toward its all-time high. The rest of the market, has gone to new all-time high. Well, not the Dow, it's close, but obviously the S&P, the the Nasdaq, those have gone to new all-time highs, and the Russell has not. So from my view here, this is something where people might actually see more potential for this to play some catch up if, and that's assuming, the market remains benignly kind of bullish the way it has been. If we get into yield spiking higher and downside in the market, then the Russell could be vulnerable in that environment. But I think right now we have to realize that there are some changes with things happening with the banks and the way that the banks have had more favorable regulatory treatment, and then at the same time the potential for more M&A. And this tax bill passing and things like that. So it could put us in a situation here where the Russell is actually in better shape. Also, look very briefly at a ratio of the Russell against the Nasdaq. And what's interesting with something like this is that it is kind of holding here. And it's again, not to say that this is anything bullish about it, but it is in a spot where it's holding an all-time low. And if it does just kind of hold here and meander higher for a period of a few weeks or months, that could be essentially the opposite. Remember, this is a ratio of the Russell against the Nasdaq. Doesn't mean it could just kind of squeeze higher a little, and that in turn could actually, represent the Russell going back near its old highs. All right, now the 10-year is, I think we're back to this being the most important chart that we're looking at. And from my view here, I mean, there's a lot on this chart here that makes me more concerned if I'm bullish. And the main thing is I'm bullish on stocks, I should say. This is a 10-year Treasury yield, and the thing is that this continues to make these higher lows, and there is a real sign that long term that yields have a problem with lots of supply and stuff like that coming to the market. So from my view here, this is now in an actually a pretty critical place where the data that we get in the next month or two and the way the market chooses to embrace it, the way we actually deal with this the tariff news and everything else could potentially determine whether or not we remain in a secular bull market for stocks. And I think the thing is that if we're in an environment here where inflation can moderate and tariffs don't turn into a big problem the way they did in early April, and we see yields kind of get back down around 4 and sit down there, this market could have some real potential. But there is really significant risk here with these higher weekly lows on the 10-year. So I think this needs to be watched. From my perspective, it's highly neutral. It's kind of, long term, there are things here that point higher, but I think we also have to realize that there is evidence of inflation getting better with oil being under control and housing costs coming down and things like that. So I think this is the one we have to watch and kind of respect it, though. If this does start to break out and get back above kind of 4.5, 4.75, there are things here that do say, you got to recognize this is a higher high than it made. That this high here in January was higher than the high it made in April. The high that it's been making ever since September of last year, ever since the Fed cut rates, it's been making higher lows. So this is something where I think if it does want to break out and move to the upside, that's going to be a pretty powerful force that will likely have a big impact on stocks. So this has to be respected. But right now, we also have to recognize the fact that it doesn't give us a clear signal, but it could be in a spot when it really does determine the overall direction of the market. Today, I will say one thing last week is that we had a big sell-off in bond prices that got some people's attention. What's her name? Hammock. I don't know her first name, but she's one of the new Fed people. But today she was more in the kind of not wanting to cut. She was giving a speech today. Hammock, I don't remember her name. But she was speaking, and she was basically more in the camp of wanting to wait before cutting rates. So that is the TNX. Now, the DXY, the dollar index, I'll just briefly touch on it because we had kind of mentioned the completion of this downward move with these kind of, 5 legs and had kind of completed, and it is now kind of pushing higher. From my perspective, this is kind of another positive. And I think that we're also in a spot where this could kind of have a benign drift, here. So I think this is an environment here where the dollar index has kind of bottomed. And in many ways here, the downward movement in the dollar has been associated with people selling American risk assets, selling stocks and things like that. So, seeing this drift higher, seeing it kind of clear the low from early June, these are potentially, I think, positive signals actually for risk assets and for stocks. So I think this is interesting. It's kind of done the first thing we did. We identified this downward move, and now it's above that. And it's above, I should say, it's above the first resistance point that we had down here at this level from the first full week of June. And now we're at a spot where this could be an important thing to watch. So I think this is also one where, some upside in the dollar here could actually take away some of that pressure of people like dumping American stocks and buying global stocks and things like that. You don't want to see the dollar screaming higher because that's normally kind of a risk off thing. But if the dollar kind of stabilizes and we lose that kind of macro, anxiety trade, then it's a spot where that could also match the scenario we laid out, which is a scenario of kind of calm and low volatility with individual stocks making big moves potentially. The XLB, the materials ETF, from my view here, this is something where it's had this really kind of big moves. There's been some deals and some M&A in there, and it's stuff with the copper tariffs and stuff like that. From my perspective here, this is a spot where people might look for a period of consolidation and then, potential for further upside. If we remain in an overall benign market and people think that we're not going to have a recession and things like that, or they think the Fed's going to cut, this could be something where people look for an extension to the upside. And I would even say that, if CPI tomorrow is relatively cool, people could look for this to kind of break out and continue to the upside. This is the XLB materials ETF. XLC, now this is one we've said is, kind of one of the big three and one of the strongest in terms of the weekly chart. We've talked about this, and this is pretty much a confirmed breakout. Netflix reports earnings on Thursday afternoon, the first big name in this. This is very similar to the Qs, and is one of the reasons why the Qs may have a kind of upward gravity pulling it higher. Is when you look at charts like this, it is kind of clearing the old highs, pulling back to hold the old highs and staying there. This is something where it may simply have the upward momentum going forward. But of course, the earnings are going to be a big catalyst for this. Netflix and then, Alphabet and Meta will be the big names for this. Now, energy here essentially is in another spot where the lower highs are confirmed. Now, there's more geopolitical uncertainty in this, and I think it kind of puts it in a spot where the technicals don't matter a huge amount. This thing they're talking about with Russia now, I mean, who knows what and how these things will work out, and how Trump tweets something or Truth Social, whatever you call it, at like 2 a.m, and then it means something or it doesn't mean something, or, I think overall you have to realize we have identified the overall bearish sort of structure in the XLE, the fact that it has not broken out to new all-time highs. It's the only sector that has not hit new all-time highs this decade. It does seem to have a bearish flag here, lower weekly highs, and increasing supply from OPEC and stuff like that. However, it does have this sort of geopolitical thing supporting it. We had the earlier involvement in the Middle East, and now this whole thing with the Russia sanctions they're talking about. So I think it's a spot here where when and if or whenever the geopolitical situation is calms down to a certain extent, people might really come and look for the energy sector to struggle further. But at this point, it's going to be kind of just very unpredictable and news driven. I will mention, though, look on the daily chart. Some of the energy stocks I do look at sometimes. There's 3 of them. These are natural gas stocks that actually were leading: EXE, CRK, which is Comstock Resources, and EQT. These are all natural gas stocks that have been performing very well. If you look overall, these guys are hitting all-time highs when other energy stocks were nowhere near all-time highs. So it's just interesting to kind of see them pull back and bounce. And I wanted to mention that. Nothing beyond that, but I did want to mention that with energy. Now, financials here, interesting sort of zone on this one. This has a kind of a high this is a weekly closing high from back in February, and then the other weekly closing high. So this is one, if you look at it, where essentially, we had that all-time record high close, and basically just pulling back and holding here. A lot of earnings tomorrow. I think we start getting the big slug of earnings on these guys. I think we have. Let me just very quickly look on my other screen here. But I'm pretty sure we have on this one. We're going to have what do you call it? We have Wells Fargo on Tuesday morning. we have JP Morgan, Citi. So the big names are coming in this one on tomorrow morning. It starts with JP Morgan, Wells Fargo, Citi. And then on Wednesday, we're going to get Bank of America, Goldman Sachs, Morgan Stanley, and then a few others later in the week. So financials here going to be an important spot, but it's interesting to see them kind of holding this level. And from my perspective here, this is something that has that potential to extend on potentially good news, but overall it's holding those levels, and that's important. XLI, the industrials, this has a confirmed breakout as well. We've been kind of talking about, we talked about at the time how this broke out to an all-time high. This is kind of the sort of pattern we're looking at. See, it closed at a new all-time high back here in early June, consolidated for a few weeks, and then extended. This pattern is one that it does work. It doesn't mean that immediately after the new all-time high it extends, but once you have that record closing high under your belt, it gives that kind of increased probability of an extension. And from my view here, this thing also with very limited downside, visible on the chart. So from my view here, this is something where it has that potential to just kind of keep sneaking higher. I will mention that Fastenal, FAST, which is an industrial supplier, had strong earnings, hitting a new all-time high. It's an interesting sort of tell for the industry overall, or for the sector. So Fastenal has been historically, one of the kind of I've noticed it seems like a little bit of a bellwether for the industrial sector because they're a major industrial supplier, which also kind of makes sense. So that was XLI. The XLK also seems to have a confirmed breakout. And so I think the thing here is that we essentially have, very tight price action. And, it could go, it's kind of holding this week. Yes, last week's is kind of holding the weekly low, and that could be kind of relevant. From my perspective here, it could kind of just sit here a little bit. And as long as it stays above that weekly low at 249.25, that's, something where essentially people could potentially view it as being still constructive with the breakout being confirmed. Remember, XLK is a third of the S&P 500 almost. XLP, and this has been one where, from my view, we've said that in a bullish market, this can be a laggard, and it has been. And I think here we are also kind of stuck in a range. And so, with earnings coming up and everything else, people might actually be a little bit wary of this thing breaking back down toward 80. Some of these companies, these consumer staples have been, not a strong part of the market. And I think overall, this is going to be something. I just say that if the market remains strong, there's a potential for some of these names to get sold on earnings, because when something is weak, very often the earnings something becomes a liquidity event. So I think here we got to realize that this is stuck. It's not breaking out. It hasn't made a new all-time high really since September of last year. So this is one when you're stuck in a range and you're kind of near the top of the range, very often it just gets sucked all the way back down to the bottom of the range. All right, that's XLP. XLRE, Real Estate Investment Trusts. This is just now contingent on the 10-year Treasury yield, in my view. If yields want to move lower, this could break out and maybe have something of a move here. I think this is also one overall that it's probably something where we need to get into a recession, to be honest, for this to maybe actually become positive. From my view here, with rates having been in an uptrend for a while without maybe significant downside, this is an area I think where there is a lot of trouble with things like refinancing properties and things like that. So from my view here, this is something where it doesn't seem to offer huge amounts of opportunity. It's stuck under this level, and it hasn't broken out to new all-time highs. So people could see 1 or 2 weeks of strength and then just kind of meandering and range-bound activity here. So from my view here, this is something where it may have risk of being very heavy for a while. Now, utilities are a little more interesting because they do have something of the secular growth story with the AI data centers and all that. And here they are sneaking higher now. Again, the all-time closing high on this one is 83.41. You know what? I'm sorry, the close 83. I'm sorry, 82.93. I have it marked. Good. 82.93. A close above 82.93 in this. This is something here where people might actually look for utilities to extend. It's pretty amazing the rally utility stocks had last year. And when you look at the overall narrative of electricity and everything else. So I think this is something we need to watch here. We've been saying a close above the high, a new closing high above the November weekly closing high. that could trigger some follow through, and we're inching toward that level. CPI tomorrow could be a big one on that. So let's just kind of keep that in mind. That is the XLU utility ETF. XLV is just pretty heavy. And from my perspective here, we've warned about the kind of just structural bearishness in this, and there's nothing here that really gives much sign of any kind of turnaround. The potential here for a head and shoulders topping sort of pattern. So I think right here the XLV remains in a difficult spot. We could see further weakness because of various kinds of Medicaid cuts and things like that, and things like this thing happening with healthcare and increased the health insurers and increased usage and things like that. There's a lot of things that have not been going terrific for this sector. Things like tariffs on the on the on pharmaceuticals. So from my perspective here, this is something where people might look also for this to kind of not be able to get much above 137 and potentially have more weakness and potential selling with earnings. That could become a selling event. XLY here, kind of trying to break out here. I'm not really sure what to make about this so much. I mean, it isn't particularly that high up the range, and there's all the uncertainty about Tesla and Amazon earnings coming as well. So people might want to really wait for more of a clear breakout above 235. One of the things I am kind of noticing here is that the Qs are breaking out, the Nasdaq's breaking out, the tech is breaking out, and consumer discretionaries are not. And one of the problems is that Tesla's a big part of it. And the other thing is this economy has become less of a consumer economy, and more of an enterprise economy, more of AI data centers and things like that. So I think we might be at the end, maybe at the end, but there's been this whole thing people have been saying really since like 2000 about, consumers drive the economy and all that stuff. We could be at a point now when that is decreasingly true. And I think the overall consumer discretionary might be in a spot here where a combination of Tesla and high valuations on things like Amazon, and the fact that, there's just a lot of random companies in there like home builders and retailers. We could be in a spot here where consumer discretionaries actually may kind of lose some of their leadership. And I think the breakout in industrials and the lagging in consumer discretionaries actually tells us something. And I think it's something that, might actually be significant. So this is at a spot where it's not that far to get to a new all-time high, and people really might want to wait for a more confirmed breakout in this before there really is significant kind of movement. It has been lagging for a while, and so I want to just kind of emphasize that. So hope everyone has a great day. We will be back on Thursday with market trends. Hope everyone has a great day. Remember CPI tomorrow, and more the big bank earnings starts tomorrow morning. Have a great day, and we'll see you Thursday.